Are you seeing signs that we're in a bubble?
Yeah.
And the obvious question is around the whole of this country and the whole of the world right now is it a bubble?
Ladies and gentlemen, on 23rd of July 2026, the American market started falling and it's the most confusing crash in history.
Hundreds of billions of dollars in AI spending and $100 oil sending shockwaves through the markets.
You know why it's confusing? Usually stocks crash when companies fail, report a loss or slow down growth. But all these companies were doing the complete opposite of it. Google generated $39 billion in cash from its operations and still lost $300 billion in market cap. Nvidia and Amazon did not even report that day. But even then, Amazon lost $120 billion in market cap and Nvidia lost $80 billion. And this caused a panic in the market that the AI boom might have just started to crack due to rising costs.
Is the AI bubble popping? You might have been watching your stocks today and wondering.
Yesterday, we saw a significant market drop that seemed to be fueled by AI disruption.
So in the last 1 week, I read through earnings reports, investor research, and even credit rating reports to understand why are US tech stocks falling, why are investors panicking in spite of record revenue, and what should you know to not lose money in this madness. Well, before I tell you about this crash, there is one crash that I managed to fix. Today, because of reels, short-form content, and constant notifications, the average person's attention span has significantly dropped. Some studies suggest that it is now around 47 seconds. And we see the effects of this in real life while we blank out during an important meeting, or we have to read the same paragraph again and again, and yet we do not register anything. This is called brain fog, and data suggests that 1 in every 3 people worldwide are dealing with this issue. Unfortunately, most of us have started normalizing it. So to deal with it, most people rely on coffee or energy drinks throughout the day. But the problem is, while these drinks may give you a temporary energy spike, they actually do not improve focus. Instead, they often lead to jitters, anxiety, and crashes. And when I was looking out for a proven solution, I found Neurogum. Scientifically, when caffeine is combined with a natural amino acid called L-theanine, it delivers calm and stable focus without anxiety or crashes. This exact science was used by Kent and Ryan, who launched it in the US 10 years ago in the form of gum and mints. That innovation is Neurogum. Each piece contains 40 mg of natural caffeine and 60 mg of L-theanine, which is the optimal combination. Caffeine helps activate your brain, while L-theanine promotes calm, focused energy. An independent MIT study even showed that people using Neurogum reached a high focus state 21% faster. And after a massive success in the US, it's finally available in India. So if you're looking for a scientifically backed solution for brain fog, you should definitely try Neurogum. The link is in the description. Let's begin with the Google paradox. Imagine a coffee shop called Brev, which had its best year with $500 million in cash coming from selling coffee. And investors absolutely love this company. But Brev's founder wants to expand very, very quickly. So this year, Brev is building 400 new outlets that cost the company $700 million. So at the end of its record year, what will Brev's bank account look like? Will it add $500 million in cash? No. It's $500 million in profits minus $700 million in investment equal to minus $200 million. So Brev hasn't lost a single dollar. So in spite of making $500 million in profits, its bank balance went down by $200 million. Now this minus $200 million is called free cash flow, which says cash generated from running the business minus cash spent on building things equal to free cash flow. Now look at what just happened at Alphabet. On paper they said we made $112 billion in profit, the highest quarterly profit ever recorded in the history of Google. Alphabet's operations generated $39 billion in cash, which is a 41% increase year on year. But they also spent $44.9 billion on AI infrastructure. So cash left with Google in this quarter is $39 billion minus $44.9 billion equal to minus $5.9 billion. This was Alphabet's first recorded negative free cash flow since 2004. And this is not a one-time expense. In total, Alphabet has committed $811 billion in total signed future purchase and obligations. And this is where the market snaps. For years, whenever a tech giant raised its AI spending, the stocks went up because spending meant confidence. But on 23rd of July, the same news made the stocks crash, where Alphabet fell by 7% and Amazon fell by 4%. But why? Well, this question leads somewhere very, very strange. If you remember from our previous case study, JP Morgan ran the math where they saw if you're investing in something very risky, you would want at least a 10% return. Their calculation says AI needs to make $650 billion every year. But even if you consider OpenAI making $25 billion, Anthropic making $47 billion, and then assume that Gemini makes $25 billion, they will collectively only make $97 billion, and that too with a combined loss of $20 to $30 billion. But if you look at the news, they are signing contracts right, left, and center.
CEO Sam Altman announcing a major partnership with Amazon this morning.
Announcing a $38 billion compute deal with OpenAI.
So Anthropic is dramatically expanding its partnership with Google Cloud.
This is a huge milestone for AMD. We are so thrilled with the partnership with the OpenAI team.
So do you see the irony? How does a loss-making company sign $500 billion deals? Well, this is where tech giants found a method called vendor financing. And it is very, very simple. Let's understand this using a story. Meet Dev. Dev makes commercial espresso machines at $12,000 each. This machine is so good that it can make double the number of coffees as compared to normal espresso machines. Now, everybody thinks New York will see a coffee boom and 100 new cafes in New York want Dev's machine. But the problem is they have no money and no credit history. So even banks refuse to fund them. So Dev makes a decision that will either make him a legend or destroy him. He says,
take the machine for just $1,000 and pay me the remaining $11,000 only when you start making a profit.
So hundreds of coffee shops buy Dev's espresso machines, and overnight his revenue explodes to $1.2 million, and the newspapers call him a genius. But look at what Dev actually did. Each cafe needs to sell roughly 200 cups a day to make its monthly payment to Dev. So Dev has not sold 100 machines. He has placed 100 bets, hoping that these cafes together will sell 20,000 cups a day. But as of now, they are barely selling 200 cups a day. So do you realize Dev doesn't have revenue? He has placed a bet. If these cafes sell 20,000 cups a day, Dev will truly be a genius. But if they sell only 1,000 cups a day, all these cafes will fail together. Eventually, Dev will lose the loan money, lose the future sales, and his investors will discover that his record revenue has completely disappeared. This is called vendor financing. Now scale Dev up by 1,000,000 times and look at Nvidia. Nvidia is in talks to provide a $250 billion financing guarantee to OpenAI to lease a data center. Why? Because OpenAI is currently burning cash. This data center is developed by a SoftBank subsidiary, and the total investment is expected to exceed $500 billion. Nvidia is also separately negotiating a chip procurement financing deal with OpenAI worth up to $350 billion. So Nvidia's exposure to just OpenAI could reach $600 billion. At the same time, Nvidia's own annual revenue is just $216 billion. Now, do you see? The money flows in a circle. Nvidia provides guarantees, SoftBank builds the data center, OpenAI leases computing capacity, OpenAI uses Nvidia-backed financing to purchase Nvidia chips, Nvidia recognizes revenue in orders and then provides more guarantee for even more projects. This is what the market refers to as circular financing loop. And there are several deals like these happening between all these companies. So do you see this? Nvidia over here is the supplier, investor, and a debt guarantor. But the question is, where is the risk? Nvidia makes what? $72 billion in profits, and it could fund everything around it, right? So where exactly is the risk? Well, there are 4 risks. Risk number 1 is if the buyer cannot pay with profits. In this case, OpenAI has signed roughly $1.4 trillion in infrastructure commitments, but its ARR is $25 billion a year. Sam Altman himself has publicly admitted that they lose money even on $200 Pro subscribers. But if OpenAI successfully decreases cost and turns profitable with its incredible Jalapeno chips, Soul and Terra models, it will become the greatest company on earth.
I think this will be the greatest thus far technological achievement of human history. OpenAI just announced its first custom artificial intelligence chip called Jalapeno.
The second risk is profit projection problem. And here's where it stops being an engineering problem and starts becoming an accounting trick. Now stay with me for 30 seconds because this is what Michael Burry, the legendary investor, spotted. Let's say you paid 80,000 rupees for your phone. If you tell your accountant that this phone will last 2 years, he will put the expense as 80,000 rupees divided by 2 equal to 40,000 rupees a year. But if you tell him that this phone will last 4 years, he will write the expense as 80,000 rupees divided by 4 is equal to 20,000 rupees per year. So for the same phone and the same money, the expense to the company is dependent on what you tell your accountant. Now, Michael Burry says that the big tech is doing the same with their chip and server life. For example, if a company buys $30 billion of AI servers and chips, if it says that those servers and equipments will last for 3 years, it must book $30 billion divided by 3 is equal to $10 billion of cost every year. But if it simply declares that those equipments will last 6 years, the cost drops to $30 billion divided by 6 equal to $5 billion a year. So suddenly the expense on paper reduces from $10 billion to $5 billion. As a result, the reported profit goes up by $5 billion a year. Now look at this table that Michael Burry posted on Twitter. It says Meta has increased its useful life from 3 to 5.5 years from 2020 to 2025. Google took it from 3 to 6 years, and Oracle and Microsoft have also done the same. Now the beauty of this math is that eventually time will tell the truth. Either the big tech is right or Michael Burry, the legendary investor, is right. So this is a risk and we'll figure out if this is actually a risk in 2028. Risk number 3 are shell companies. Let me show you how. You see, the AI data center build out is priced at over $3 trillion in the coming years. JP Morgan says it's over $5 trillion once you include power plants. But do you realize nobody has $5 trillion in cash? So the question is, where the hell is this money coming from? Well, it is being borrowed using shell companies. How? Look, Meta is building a giant data center which costs $29 billion. But Meta did not borrow $29 billion. Instead, a brand new shell company called Binet Investor LLC was created, and that shell company borrowed $27.3 billion from bond investors due in 2049. This shell company owns the data center, and Meta is merely the tenant paying rent and only owns 20% of the venture. Now, why this arrangement? Because Meta gets its data center without $27 billion of debt sitting on its own balance sheet scaring its shareholders, and the bond investors get to lend out money with the reliable stamp of Meta. All of this assumes that Meta will be able to churn out profit from that data center. This is how Meta, Alphabet, Amazon, Microsoft, and Oracle collectively carry $1.65 trillion in AI-related debt. And lastly, risk number 4 is if no one makes profits, Nvidia will lose its revenue, equity value, and loan. And that too, all at the same time. This is why pessimists believe that if this profit doesn't come, it's going to cause a disaster. For those who don't know, there is a financial instrument called Credit Default Swap, or CDS. In simple words, if a bank lent Adam $10 million and the bank is scared that Adam might not return the money, this bank could go to Michael and buy an insurance. This deal says that the bank pays Michael $1,000 a month with the condition that if Adam fails to repay the $10 million, Michael will pay $10 million to the bank. So what the bank bought is called a credit default swap to secure its money. In short, insurance for its loan. And as we all know, if the asset is too risky, the price of insurance goes up. And on 27th of July 2026, the day Nvidia OpenAI news broke out, the price of insurance on Nvidia's debt recorded its biggest intraday jump, which indicates that investors are now scared. So while the equity market spent a year celebrating Nvidia, the insurance market is a little paranoid. As they say, while the stock market tells you what people hope for, the insurance price tells you what they fear. And on 27th of July, this fear became very, very evident. So this shell company structure of the free cash flow problem of Google, the circular financing of Nvidia, depreciation calculation, the enormous debt, and the oil prices, all of this put together seems to be causing a paranoia that kind of explains the story behind the US market fall. So now the question left is, will the token cost go down? Well, the token costs are going down dramatically, and if they go down dramatically for the next 3 years, just like they did in the last 3 years, enterprises will use AI in every single operation. OpenAI and Anthropic will become profitable, Nvidia's projections will become true, and it will be the greatest bet the world ever took. And if they don't, well, you know the story already. If you ask me, I think it's difficult, but considering OpenAI, Anthropic and Google, I think if any company can do it, it is these set of legendary companies. So let's hope that they do something crazy, because if that happens, humanity will see the next century in the brightest possible manner. This is my hypothesis on why the US markets are falling, and I just hope you learned something valuable from this case study. That's all from my side for today, guys. If you learned something valuable, please make sure to hit the like button in order to make YouTube happy. And for more such insightful business and political case studies,